they would typically, on a $50,000 investment, give a 6% preferred return, which is, just for those that don't know what a preferred term is, it's just the first 6% profit that a deal would kick out would go to the limited partner investors. So that's the first kind of hurdle. And then past that 6% return would be a 70-30 split. 70% of the profit after the 6% would go to the investors, 30% to the general partner team. So I might get a 8% preferred return, 90-10 split. So I might take part of that economics and pass on a portion of that to my investors. So a very common amount that fund managers get paid, just like a real estate agent would get paid, is a 2% acquisition fee. And then whatever that split might be. So often on my fund level, it's either an 80-20 or an 85-15 split, meaning investors win first. And then if we do a good job stewarding and managing the business plan, then on the tail end, that's often where most fund managers make most of their profit.
Hi, Adam Gower here, founder of GowerCrowd.com and host of The Allocator, a new way to invest in real estate. Thank you so much for joining me today. My guest today is Nick Stromwall of Oak and Vine. Nick is a 3-year standing commercial real estate capital allocator, and he is going to be talking about how he puts deals together, how he structures them, what kind of fees he charges, and what kinds of sponsors he looks for, how he finds investors, etc., etc. Fascinating conversation today. You're going to love it. If you've not done so yet, please go to GowerCrowd.com and sign up for my free weekly newsletter, where I cover all kinds of guidance and insights into real estate capital formation and also on real estate investing based on my extremely long and actually embarrassingly long history in this industry, leaning into some of the lessons that I've learned. It's all there. GowerCrowd.com. Hit the subscribe button. Oh, by the way, while you're there, you'll also see some of the companies that subscribers work for there. All right, without further ado, here he is, Nick Stromwell, Oak and Vine, coming up. Nick, how nice to meet you. Oh my goodness, I've seen you so much on LinkedIn. That's how we got to know each other. Thank you for joining me on the show today. So let me kick off high level with a simple, open-ended question. What do you do in real estate? And then we'll dive into the details.
Yeah, thank you so much for having me on. Excited to just spend a little time face to face. You get to know people on LinkedIn, but it's much more powerful when you can take those conversations into more real life situations. So my name is Nick Stromwell. I founded Oak and Vine Capital a couple of years ago, and very simply, I help people multiply their money so they can multiply their impact.
So how do you do that?
So I spent 15 years developing leaders on the college campus and just quickly found that our world is broken. There's so many problems out there. And I think the two best ways to solve the world's greatest problems are investing in alternative assets and starting businesses. So I tried to put those two together. And really, I want to help people live the life of their dreams where they're winning at work, winning at home, and winning in community. Kind of coined this phrase, the triple win. So put simply, I help people invest $50,000, $100,000 at a time with the goal to help them double their money every 5 years.
Okay, but you do that in real estate, don't you? So let's get
Yeah.
into the actual. I want to unwrap the actual process. So I'm just going to tee this up a little bit. You help me fill the gaps.
Wonderful.
But basically, what you do is you find sponsors or real estate sponsors that you like. You negotiate preferential terms. I'm guessing. You correct me if I'm wrong. And then you market those to investors in your network. So just kind of unwrap exactly what the process looks like.
Yeah, you got it. Yeah. Forming relationships is definitely the foundation. And I'm really looking for operators that have a proven track record in their particular asset class. So I'm asset class open, location open, but pretty strict on who I want to partner with. So I've done multifamily, industrial, private credit, oil and gas. I'm underwriting some precious metals and crypto fund opportunities as well. I would say the bread and butter is multifamily, usually 100 units and up, and have 4 or 5 different markets that I really prefer. So exactly what you said, I'm looking for those operators that can identify those deals. Then I'm bringing in the capital through my network of investors to help fund those deals. And I'm often looking for opportunities where people coming in through the funds that I create get better returns than going through the sponsor themselves. And that's just because I can bring in or partner with other fund managers to get a higher capital threshold and to get better overall returns for my investors. So you got it exactly right.
Okay, so let's kind of keep dealing diving a little bit deeper.
Yeah.
So how do you find sponsors and how do you gain confidence in sponsors being somebody you want to invest with?
Yeah, so I started investing in real estate about 13 years ago and really started focusing on commercial around 3 years ago. I've joined several different mastermind communities where I've been able to spend kind of longer periods of time, weekend retreats, training times. And then a lot of it is just jumping on calls, meeting people for coffee, trying to figure out who this person is and what they're about. There's a lot of operators out there and there's a lot of people in this space, but I would say there's very few that really have a kind of a vision for using their business as a vehicle for impact. So it's kind of I kind of weed through the different people. Right now I'm on about 50 different operators lists, and I'm partnering with just a small portion of those operators that number one have a proven track record, number two have the mechanics in terms of the deal fundamentals that would make sense for those double digit returns, kind of that 2x equity multiplier over the 3 to 5 year period. And then more importantly, how do they care for their people? What kinds of programs, initiatives are they trying to squeeze every little bit of profit out of the deal, or do they want to build a community? And I'm focusing on the operators that want to build a community. They want to bring in groups like Apartment Life or have monthly, quarterly times where the tenants can get development. One of our properties in Des Moines, Iowa, we converted one of the 2 unit apartment units in this 50-unit building. We created a learning center so that the tenants that live there can learn English, have school help for the kids after school, and also get some job training skills. So it's a different type of operator than maybe what you kind of see marketed, because I would consider myself an impact focused investor where I want to help people not only get that really good return, but also like really care for the tenant. And my test is pretty simple with the operator. Take them out to lunch, and just see how they treat the waiter or the waitress. And pretty much within 2 minutes, I can determine this is someone I'd like to do due diligence on. Got a 75-point checklist question that I'll go through, background check, really do a deep dive into who this person is and the deals that they've done, the people that they've worked with. So I kind of take out the for a investor, I take out the heavy amount of work doing the due diligence on the individual sponsor. Whereas a lot of people might just look for the best deal or the best IRR. That's like the term a lot of people go after. But I'm kind of looking at the full picture to try to find those really good opportunities for my investor network.
Right, and you mentioned you've been involved in commercial real estate for the last 3 years and that you've been
Yeah.
to some masterminds. Which ones have you found the most useful of the masterminds?
So I joined a mastermind called Kingdom REI around 3 years ago. And that was a network of faith-driven leaders. They're just learning how to do commercial real estate, learning how to find the deal and how to raise capital. So that's probably been my favorite one. I joined as a member and then I was actually on staff. And now the last 2 years I've just been doing Oak and Vine full time.
Very nice. And so you talked about terms, right? Getting better terms from the sponsors.
Yeah.
So actually, give me some specific numbers by way of example. If there's a case study, you can
Yeah.
describe something we understand.
Yeah, one of my partners, they would typically on a $50,000 investment, give a 6% preferred return, which is just for those that don't know what a preferred term is. It's just the first 6% profit that a deal would kick out would go to the limited partner investors. So that's the first kind of hurdle. And then past that 6% return would be a 70-30 split. 70% of the profit after the 6% would go to the investors, 30% to the general partner team. So that'd be like a standard, six pref 70-30 split. I'll often negotiate a 7% pref, either an 80-20 or an 85-15 split for my investors. So, on a $50,000 investment, it might mean the difference between an additional ten to $15,000 of profit over those 5 years.
And is there, when you do that, presumably you have like what incentivizes the sponsor, comma, presumably you offer to bring more than just $50,000. So
Yeah.
explain how that works from the sponsor perspective.
Yeah, there's kind of different thresholds for an investment. So a standard investment might be 50 or $100,000 minimum. If you get above 500,000, that's kind of the next bump. Over 1 million is another bump, and then usually over 2 or 5 million would kind of be that final bump. So I'm partnering with other fund managers and often bringing 4 or 5, $6 million into an opportunity where we're able to negotiate better terms that not only pay for our fund manager fees, but also give most of the proceeds to our investors.
Okay, so that does actually dovetail into my next question. So how do you make money?
That's right. Yeah. So it's usually just the differential between the amount that I'm getting. So I might get a 8% preferred return, 90-10 split. So I might take part of that economics and pass on a portion of that to my investors. So a very common amount that fund managers get paid, just like a real estate agent would get paid, is a 2% acquisition fee. And then whatever that split might be. So often on my fund level, it's either an 80-20 or an 85-15 split, meaning investors win first. And then if we do a good job stewarding and managing the business plan, then on the tail end, that's often where most fund managers make most of their profit.
Okay, so the fees that you charge, you said 2% on what?
2% acquisition fee, and then it's usually either a 0.5 or a 1% asset under management fee. So
Well,
it's kind of,
hang on. So let me just understand that. So you go
yeah,
to a sponsor, and let's say they buy just for argument's actually, it'd be good to have an actual example, but just for the purposes of our conversation, say they buy a $10 million deal, $5 million of equity is necessary. You come out with 2 million for argument's sake. What,
yeah,
that 2% is on what that you charge?
2% on capital raised. Yep.
Okay, so your fee is 2% to your investors.
Two, so you're asking a good question. So there's a difference between the project level return and the
Mm.
fund level return. On the fund, let's say I would raise $2 million on that fund, I would get an acquisition fee on that $2 million, which is often 1.5 to 2% of the total amount of equity raised. So that would
Who
be the,
pays that?
say that again.
Who pays that 2%?
The investors would pay that out of the equity that they are bringing into the deal.
Okay, all right.
Yep.
So,
Yeah,
okay, so they pay two. So where if somebody invests half, say 100,000, you would get 2,000 from that
that's right. Yeah.
from the investor.
Yep.
Okay, and then okay, and then you also, but you pass through some of those beneficial terms to the investors, right?
That's right. So instead of them getting like a 6% preferred return, they're often getting a 7% preferred return, which usually kicks in anywhere from 60 to 90 days after a project is started when the asset is closed upon. And then they're often getting some type of monthly distribution. So every deal is different. A lot of times the distribution is going to be less than that preferred return because we're often injecting a lot of capital into making the units nicer, improving the overall property. But that preferred return accrues, so they're going to get paid out that full 7% preferred return. And then on top of that, which usually happens year 3, 4, or 5, when we would go what's called full cycle, we'd either refinance or sell the asset. Then the investors would often get 80 or 85% of the proceeds, and then the general partner team would get the other 20 to 15 to 20%.
Okay, and then you also you take a delta as well. You take a bit of a delta on the pref and also on the promote as
You got
well.
it. Yep. Yep.
Yeah,
Those
and
two
then you said you charged an assets under management fee. That's an annual thing, is it?
annual. Yep. Usually 0.5 to 1%. Yep.
And that's on the again, that's something that's something that the investors pay.
That's exactly right.
Yeah.
Yep.
And you talked about a fund. So just explain that to me. So I was thinking these were deal by deal basis. So what do you mean
Yeah.
by fund?
Yeah, there's lots of different ways to raise capital. I've done joint venture, which is kind of more simplistic, form an LLC. Partners have different roles and responsibilities. There's a syndication model where you might become a co-GP with other co-GPs and have duties associated with being that co-GP, whether it's asset management, raising capital, investor relations, working with insurance agents, or you can create a single purpose vehicle fund to fund. And the value of creating a fund to fund is you can partner with other fund managers and bring in that larger amount of capital into a deal. It's really the cleanest way to raise capital. And I think it also gives the most amount of potential benefit to the investors because every capital raiser has a different threshold of amount of capital that they could raise for a particular deal. But I found partnering with other fund managers allows us to each bring our network into an opportunity to get the best overall mechanics and return available for our investor base. So our fund would be one of the limited partners inside of an actual deal. And that fund might be made up of 10 or 50, even 100 different investors in that one single purpose vehicle fund to fund.
Right. And it's also might be a group of allocators who
Yeah,
contribute to that fund.
that's right.
Right. And so when you set up a fund, do all the allocators like you offer the same terms to their investors, or do they have different terms?
All the same terms, and it's there's sometimes different thresholds. So if you know, are 50 or $100,000, that might be one set of deal mechanics. If you're over 250 or 500, that might be another set of deal mechanics. So depending on how much capital you're bringing to the table, the more capital you bring, often the better overall terms you get.
And the AUM fee that you charge and the acquisition fee, that's split pro rata to all of the fund managers, you want to call it, that go into an individual fund.
That's right. Yep.
And who manages that? Who manages the fund typically if you've got
Yeah,
multiple allocators? Yeah.
there's usually one kind of lead fund allocator that takes on a lot of the individual duties of, you know, working with the bank, working with setting up all the legal documents, interacting with the lawyer team. And then either that person is kind of doing all of the work, making sure people move through the process, or there's a team like a TribeVest or another team that helps facilitate moving people through the process because it's often a couple different steps. One, there's the opportunity presented, and maybe it's a webinar or an email goes out. Then there's a soft commit saying, "Hey, reserve a spot. I'd like to reserve this amount." Then there's a legal paperwork. So opportunity, soft commit, filling out the legal paperwork, and then there's actually wiring the money in that kind of seals the deal to lock in your spot in that particular opportunity. And it's kind of really interesting, Adam. The last three multifamily deals I did in 2024, we would present the opportunity and then kind of say, hey, in 1 week, when that email goes out, get ready because it's going to fill up quick. And often within 4, 6, or even 8 hours, our entire allotment of the capital that we could bring into an opportunity would fill up because I think it's just a really, when there's really good deals, people want to jump on it.
So how much have you raised uh, overall, and how much in 24?
2024 raised a little over $3 million of total equity. The different teams I was a part of, we did over $16 million total. And then over the lifespan of Oak and Vine being in existence, I'm about $4.5 million of equity raised.
Oh, and 3 million last year.
Hmm.
So last year was a big year. So why was
Yeah.
last year such a good year? Because most people had trouble last year.
I really went full time in January. We had our fourth child in February, so I kind of had a little bit of time off there.
Congratulations.
Thank you. Yeah, we're really blessed. We have three sons, and we had our first daughter, so it was a
Very
real
nice.
treat. Um, I just think at the end of the day, when you connect with people, you find really good opportunities. And I think there's still some hunger and appetite out there to get outside of being controlled by people's 401k or kind of the traditional markets. I think you can often do a lot better in the alternative space. I kind of consider investing in stocks and bonds as hitting a single in baseball. You're going to get that cash flow coming in the form of dividends or proceeds. But often in alternative assets, you can not only get the single, but you can also get a double or a triple. You can get that cash flow, number one, the appreciation of the asset over a 3 to 5 year period of time. And then you're also getting some pretty substantial tax savings as well. So I find the opportunity to invest in alternatives is a multiplicative way to grow your wealth. And for me, like my first goal is to earn $2 million a year because I want to live on 10%, 200,000, and give the other amount away each year. I've got a lot of people, nonprofits, and different things that are really passionate for myself and my wife that we want to get behind. So we're using the vehicle of alternative assets to grow our wealth so that we can make really incredible impact.
So how do you invest in the deals as well? Do you personally invest in the
Yeah,
deals?
personally, yep. Yeah.
And so as a proportion of that 3 million last year, typically how much do you invest personally?
It's deal dependent, anywhere from 10,000 to $100,000 into each individual deal. I had the benefit of having some family members who are financial advisors. So my method, coming out of being a college minister, not earning a lot of money, was I had started investing in my Roth IRA when I was 16 years old.
Mhm.
And one of the cool things you can do is you can convert money from your IRA into a self-directed IRA, and then through that self-directed vehicle, invest in these syndications. So my wife and I primarily have been investing through our self-directed.
And so how old is the oldest, or how long standing has been the oldest deal that you've invested in or that you've worked on as a capital allocator? You said you've been doing CRE for 3 years. So what's the longest standing deal?
Yeah, the longest standing deal would be November of 2022, was a multifamily project in Des Moines. Prior to that, in 2012, we invested in residential real estate. So we had a small portfolio of single families and duplexes. We started an Airbnb, and really we got into the commercial real estate side because as a husband and father of multiple kids and a leader in this ministry, it became overwhelming to manage all of these individual properties while still being a present husband and a present father. So really the way into commercial real estate was I was kind of tired of being an active landlord, of running around, cutting the grass, fixing stuff when it broke. And I was looking for more of a passive solution to take the capital that I've been working really hard at, to convert that over to more of a passive solution where I could find that opportunity, that operator that I knew, like, and trusted, who had a proven track record that was doing great work and caring for the people, and invest with them and just kind of sit back and collect that mailbox money, each month or each quarter.
So looking back at those earlier deals that you did, how have they been doing over the last couple of years?
Yeah, hitting really good. We were fortunate enough in 2022 to have fixed rate debt. So we didn't really have the problem that a lot of people faced with the variable interest rates and the interest rates going from 4 to 8%. So we were kind of spared of the carnage.
What have you seen in terms of you've been 100% spared, have you?
100% spared so far. Yeah, 9 for 9 so far on the 9 deals that I've invested in personally.
And what have you seen out there with other allocators and other fund, people like you allocate, capital allocators?
Yeah, I think there's different networks of people. Some have been completely spared, where they've been really conservative. They raised a lot of additional capital to make sure that they had the reserves to weather the storm. Others that didn't have that, either the debt rate, or the fixed um, debt cap, or they had the variable interest rate. They either had to sell their properties at a discount, or I have one friend who actually lost all of his capital and lost capital for some of the investors. So you hear about those stories, and it's you pray that you don't have that happen. And yet, in this commercial real estate world, I never guarantee any type of return for my investors. I tell people up front, hey, you could lose all of your money. I just want you to know that going into it. Here's our business plan. Here's strategy A, strategy B, and strategy C. I believe, based on the market and based on what I'm seeing in my underwriting and due diligence, that here's why I think this is going to be a successful plan. I typically give people a range of how I think a project is going to go. So on some of my last deals, the projected equity multiplier was, a 2.04 to a 2.08 over 3 to 5 years. And people often ask, well, is it 3 years, 4 years, 5 years? And I just say, well, there's no crystal ball. Here's our plan for how many units we're going to renovate each month and each year. Here's the plan of attack that we're going to do. We can't foresee the future. We don't know where interest rates are going to be. If we can get around a 20% average annual return in 3 years, that's probably a good trigger to sell instead of waiting for 5 years. So I kind of like coach my investors that it could be up until 5 years. It could be a little longer. And often it's in that 3 to 4 range that a deal would go full cycle. But I'm not after one-time investors. I don't push people into opportunities. I've had lots of investors that have been in my email education sequence for over a year before they feel comfortable to invest 50 or $100,000 into a deal. And I'm upfront. Hey, here's how it's gone for me. Here's our past opportunities and how they've been performing so far. But here's why I believe that this is a great opportunity for you to multiply your money impact.
What do you think are the lessons learned amongst those who have lost money, amongst the allocator community? What have been the lessons they've learned? What have you learned from
Yeah,
their
I think
stories?
a couple of things. If you're gonna buy a deal where you're having floating rate debt, get a rate cap. And I think people didn't know that. Who would have expected the interest rates to go from 4 to 8? But I think that's probably the number one lesson. If your strategy is to buy a variable interest rate, some people don't want to do that. Some people just want to do fixed rate debt. I think there's different pros and cons there. And then number two, like raise an amount of capital for your reserves so that you could weather a storm if needed. Often, 10 to 20% of the overall purchase price could be a really healthy amount to have available so that if something major happened, you need a new roof. You weren't expecting, you're projecting 16 to $18,000 a unit, but you found something and now it's closer to $20,000 a unit, or the price of materials shot up for an unknown reason. Like you got to have those resources available. And I think people try to do too much too fast. So the slow plodding is often better, thinking about the race as a marathon versus a sprint. I think that would be the other major thing that I've saw.
What are the biggest challenges you face as a capital allocator?
I think the biggest thing is just earning the trust from people you don't yet know. And you can't really go from zero to investing $100,000 often in a day. It takes time, it takes education, it takes daily showing up, it takes the daily posts on LinkedIn. It takes being willing to jump on a 10, 15, 20-minute call, having investors that would be happy to jump on and say, hey, this is what it's been like to work with Nick and Oak and Vine. So I think in an ideal world, if you could go from zero to $100,000 invested, that would be awesome for a capital raiser because you could scale and do a lot more. But I'm not after the quick, getting rich overnight. Like I want to slowly plod along to be able to get to that $2 million a year of income. I'm okay that taking 5 or 10 years if need be.
And so what have you found are presumably a big important factor for you is finding investors.
Yeah.
So what have you found are the best ways of doing that?
Yeah, I think LinkedIn outreach, where you communicate problems that investors often have. So I think the main problems investors have is
Mm.
they don't know any other way than putting money in the stock market. They are scared to try commercial real estate because they've never done it before. They've kind of heard like, hey, you should get an Airbnb or you should own a rental property, and they don't realize how much time that brings in.
Mm.
And then I think just presenting the opportunities in a timely way where the timing for when someone's assets capital is available from when the time it needs to be deployed into a deal. So I found the most helpful way is the daily posting on LinkedIn, having an educational email sequence that you can bring people in at any point. And then other events that you have, whether it's in-person meetups, I've been able to present here locally in the Twin Cities at various meetings, and those are great opportunities to get to know people. I think the best way to find investors is when you do such a good job that people tell their friends, hey, I put in $100,000 in this investment and I'm already getting 15% returns. Nick said it wasn't going to happen for 2 years, but the over delivering and under promising is one of the best ways I think as a capital allocator to really um, meet those people and serve their needs. So those are the ways that I found to be effective. I think creating content is just one of the ways to do that. But really, the best way is sending those messages. Hey, I have this free uh, personal financial statement. Would you be interested? Hey, I have this free educational email sequence. Hey, I know you're trying to save on taxes at the end of the year. Did you know that this is an opportunity for you? And just I'm sharing the things I'm learning as I'm reading books and going to seminars and engaging over the different types of opportunities out there. Because in the alternative asset world, there are so many cool ways that people are stewarding their resources to help people get great returns.
Yeah, and of course, you're selling securities. I mean, we're obviously all in the securities world here. How do you stay compliant with those regulations? How do you learn about them? How do you stay compliant?
Yeah, I mean, there's different types of opportunities, whether it's a JV, a 506B, or a 506C, and each of those requires a different level of communication. So for accredited only opportunities, 506C, you can broadcast those, you can send emails, you can talk about those online. For the 506B, more for the sophisticated investors, you have to have a pre-existing relationship with the person. So I have some automations and AI set up where when I have a call with someone on Skype or Google Hangout, I'm able to record the main points of those conversations automatically into my CRM. I have different email sequences and text sequences where I can begin to form those relationships. And I really can't present opportunities for 506Bs until I have that pre-existing relationship with someone. So I think tracking using technology and systems, which I know you're really keen and you have a lot of great insight on how to use systems and AI to really facilitate those connections. But at the end of the day, it's just the hard work of forming relationships, Adam. I think at the end of the day, that's what sales really is you present people an opportunity. And if you've got a good system for follow-up and engaging people, that typically over the long haul will get investors in the door.
Okay, so let me move. At the end of our conversation, I have five rapid fire questions I'm going to ask.
Also,
Rapid fire. But before we get to those, let me ask you, so the capital allocator industry, how are you seeing that? You've been involved in that for 3 years. Is that correct? Yeah.
yeah.
So how have you seen that changing and evolving?
I think people are starting to see the power of forming a capital business where they can tap into their network. A lot of people kind of start off doing it on the side. It usually takes a couple of years for people to generate enough income where they could leave their job and do it in a full-time basis. So I'm starting to see a lot of part-time people beginning to understand the industry, taking enough education to be able to do it. But I think more and more people are starting to see the light with the opportunity that there is in the alternative space even with registered investment advisors, a lot of them are opening up the idea of putting more of their uh, overall portfolio into these alternative opportunities. So I think the market is ripe. People are hungry for more stability. I think there's been great years in the stock market and some really challenging years, but I think the overall opportunity in the alternative space is really the selling factor of why a lot of people are jumping in.
All right, let's move to these rapid fire questions.
Okay.
What has been the hardest lesson you've learned in your career in real estate?
Um, in one of my deals last year, I had to fund the entire amount of the cost of setting up the fund. And that was just a big upfront cost of over $20,000. So just being ready when there's a good opportunity, have the resources available to invest.
What do you think is the makes for a successful capital allocator in today's environment?
Yeah, I think just showing up, under promising and over delivering, and just being available for your network of investors.
If you could go back in time, Nick, and give yourself some advice when you were starting out first in commercial real estate, what advice would you give yourself?
I would say I would not give in to fear with beginning to establish my brand online because I think I was just really fearful to just start talking about what I was learning. It's a scary thing to put yourself out there, but it's been so rewarding. And I love getting the messages from investors just thanking me for the opportunities to invest.
And again, talking about capital allocation business, right? This kind of industry. What are the biggest misconceptions that people have about the industry in general?
Probably that people who are doing it are automatically rich. I think a lot of people think of a capital allocator as someone who's raising multi-millions of dollars, and I think they translate that to they're probably driving lots of fancy cars, but it takes a good 3 to 5 years for some of your deals to go full cycle before you start really earning substantial amounts of money.
Last question. So I'm going to ask you for advice to three groups.
Okay.
Advice to new investors looking at real estate,
Yeah.
to allocators, and to sponsors. So bifurcate or trifurcate that. What
Yeah.
advice do you give to them based on your experience?
Yeah, I think for investors, find someone you connect with that's doing great work. There's industries if you're a pilot, there's industries if you're a faith-driven leader, there's industries if you're into engineering. Whatever your industry is, find someone who's doing it and then just ask them to jump on their email list, jump on a call with them. I think for capital allocators, utilize the power of technology. We live in an amazing age where so much of your daily work can be systematized and delegated either to AI or to maybe even some type of assistant. So leverage your time as much as you can. And I think for sponsors, um, man, I think people are hungry for that impact more than just the overall return. So don't be afraid to uncover like what you are really passionate about and why you're doing what you're doing. I think so many people lead with the financial returns when inside they might have some passions or some things that just break their heart that they want to get behind. Lead with that because I think people are hungry to get behind those types of initiatives.
Nick Stromwall, founder, Oak and Vine. What a pleasure to meet you in person, kind of. Thank you for joining me today.
Yeah, what a treat. Thanks.
All right, that was Nick Stromwall of Oak and Vine. Thanks so much, Nick. What a pleasure actually meeting you. It's kind of weird to say, but meeting you in person. It's what it feels like when I meet people on Zoom these days, having migrated from LinkedIn, for crying out loud. Feels like it's in person. Anyway, thank you for joining us. It's a real pleasure. I enjoyed hearing your insights and your mission and what you're doing. And thanks for sharing them. And thank you too, dear viewers, for joining us today. I hope you found the conversation as interesting as I did. And if you've not signed up for my newsletter, please go to garacrowd.com, hit the subscribe button there. It's totally free, it comes out every week. You can always unsubscribe. All about real estate investing, leaning into my experience and insights from my very long career in this industry. All right, that's it for this week. Thanks again for joining me. Until next time, this is Adam Gower signing off.